welcome to the FSC's update with the Reserve Bank of New Zealand. Thank you all for joining wherever you are around the country. In for a really interesting discussion. It's been several weeks now since we last met as a group on this particular topic with the senior team from the Reserve Bank, and so much has changed. So within the FSC, we thought it would be really valuable to have another of these discussions where we can engage with the Reserve Bank, find out where the pulse is, the pulse of the nation, so to speak, and also get a bit of a sense of asking some questions on the issues that are kind of key and important around the sector. So a very warm welcome again. I'm going to hand to Rob Flanagan just to say a few words of welcome, and then I'll just come back with a tiny bit of housekeeping, and then we can just jump on with the program. Rob, welcome, over to you.
Thanks, Richard, and on behalf of the FSC board, we welcome you all here today, and we especially welcome Geoff, Toby and Richard from the Reserve Bank. We really appreciate you taking the time to talk to us and to sort of update us on the Reserve Bank's view on how New Zealand Inc. is tracking under another lockdown, and also perhaps your views on what the outlook could look like when we come out of all of this. So thank you everyone for coming up. Sorry for tuning in. And Richard, back to you.
Thanks, Rob. Folks, just brief housekeeping. Feel free to make this as interactive as possible. I think we're all got to be pretty expert on Zoom these days, so there's a Q&A bar at the bottom of your Zoom bar. Feel free to ask all and any questions. To Rob's point, a very warm welcome to Geoff, to Toby and to Richard from the Reserve Bank. We have worked together really closely over now a long period of time, and these events and discussions have been immensely valuable as we've kind of come to live and learn to live in the new normal. So Geoff and Toby and Richard, I think in that order, will probably say a few words each, and then we'll come back for an open forum and discussion. We are on the record today, so we will be recording, and we will make this video available post the event. But on that note, Geoff, Toby and Richard, a very warm welcome, and balls in your court. Thank you.
Kia ora koutou. Thanks, Richard, Rob, for the introduction and opportunity again. Appreciate chance to talk with you all. And yes, so I will say a few words on how we're reading the economy, the sort of, in a sense, post MPS story. Toby will update a little on our regulatory agenda. We are starting to get towards if you like, recommencing a few things or talking about how we're going to do that from October onwards, really. And Richard's got some updates, including some information on cyber issues that are besetting the sector a little bit at the moment. So we'll do all of those things. Let me just start with the economic picture. When we put the MPS together in middle of August, we ended up releasing it on the same day that, of course, the the increased alert level for Auckland happened, and a couple of days later, Auckland went back into level 3. We were aware of that announcement and impact. I suppose at the time, I have to say that it didn't have an enormous consequence on our outlook, and I say that because when we put the outlook together, as much as it's a scenario rather than a specific set of forecasts, the big message was we saw the risks to health and therefore to the economy still to the downside. And I guess in a way, this just emphasised or demonstrated that was a real thing. We actually started the baseline scenario with the assumption that we'll be have international borders closed until the end of next year, and that there would be no generalised further outbreak of the virus in New Zealand or generalised lockdown, but that the world would still be suffering its impacts and dealing with it for a significant period of time ahead. So we still saw the world being significantly disrupted through 21, and I know we've all talked about possible bubble, trans-Tasman bubbles and things, but it wasn't in our assumptions. And it was a sort of like, well, if it gets better, all in good, but actually we see this world as being pretty tough. So the other part about the outlook at the time, and which was interesting, was we were in a period where people were feeling a little buoyed by having got back into level 1, and we were seeing some signs that spending had come back. Credit card, electronic transaction spending was up, back up to where it had been before the lockdown in March, and the labour market wasn't looking as bad as people had been, including us, had been expecting. So we acknowledged that in a way, at that point, it wasn't quite as deep as we had expected, and we'd recovered a little better. But on the other hand, we had this longer headwind, if you like, strong headwind for a longer period that we were looking at, and we were leaning into a world that was going to go on longer. It wasn't a quick world recovery coming. And as I said a number of times, New Zealand depends a lot on the rest of the world. Obviously, flows of people, but also goods, the markets, confidence, all sorts of things. So there was that balance of slightly better domestic, slightly weaker, longer world that left us saying, well, overall, we didn't actually think the outlook would have been that different from May. Don't get too carried away on this. We've still got a long haul to go. We interpreted the labour market as being sort of delayed, that if you look below the headline numbers, unemployment at the end of June was on the weekly data was up above 6%. Underutilisation was high. Income loss was still significant. Wages, earnings were down. And of course, all of this is being supported by the wage subsidy that's been extended a bit, but is still finishing in not too distant future. And so, I guess what we did was we said probably not quite as high a peak in unemployment, or if not quite as severe, but probably a slightly slower recovery. So in a way, we pushed it back a bit, said we'd probably be more like 8% and slowly grinding our way down to 6, or just under 6 perhaps in a couple of years' time, but quite a prolonged period of the household sector suffering under lower income and greater job insecurity. Intriguing things. Obviously, there's a push-pull going on. We said we're going to keep interest rates low, and we need to keep them lower still. So I'll come to the policy response in a moment, but we have seen mortgage rates fall quite significantly. It's fallen quite a lot since May. So whereas in May we'd been a wee bit worried about the pass-through of what we were doing in our policy to retail rates, in August we were more confident that it was passing through. And so in the household sector, in a sense, they're getting the benefit of those lower rates, and the housing market's probably stayed a bit stronger than we expected, and the unemployment impacts have been delayed a bit, but we still see that tug of war going on, and we still think low migration, higher unemployment will weigh and bear on the housing market in due course. Maybe not as much as we'd said, but we still think there's some softness and some drop in prices to be expected. So story is sort of pushed out a little bit, but broad overall picture is still one of a tough world, a big economic shock that's hit us in a significant way. There's no doubt that the June quarter was a massive blow to the economy, and it takes quite a long time to recover. So what about the additional Auckland lockdown? Well, as I said at the time, we didn't know how long it was going to go for. At the moment, we believe it's finishing on Sunday night at level 3, and then we get back to level 2, which fortunate for all. But a couple, 2.5 weeks of severe lockdown does take another dent out of the economy, and in particular, a lot of businesses that were already fragile, sort of probably still teetering, or even more so, teetering on the edge a little bit. What have we seen in high frequency indicators? Not a huge amount of change. On activity, they've certainly come down. Mobility, travel, spending has softened. In terms of stress, there's been a little bit of a tick up in missed payments, a bit of a tick up in business requests for business loan restructuring, but not major so far. Hardship claims haven't changed a lot in the reported data. But of course, these are lagging indicators. These are ones that we're reporting to sort of the 21st of August, really about what was happening in the first half of August. So, still to see what happens in the second half of August when this is hurt a bit more, and see that in the early September data, I suppose. So I'd be surprised if it doesn't have some more negative impact. It just weaken things a bit. But, I wouldn't want to exaggerate. I think the big picture as a world is still a very tough place for a long time. And we, I guess, have to be mindful we could have further lockdowns in future. So policy response, well, I guess the big, the big story, of course, is that fiscal policy is still the main player. The secondary story is monetary policy is doing its part to help, and we are continuing to do so. We said that we think we need to do more to help the economy. We're pleased with the way that the asset purchases are flowing through to lower bond and swap rates, and ultimately into lower retail rates. But we've indicated that we think probably more stimulus could be required, and particularly if we don't see, positive signs of response to the support that's been there. And so we indicated that if we were going to do more, we were looking at potentially a package of negative OCR and a funding for lending program, which is sort of lending to the bank at close to the OCR rate. So it reduces the cost of funds to the banks to enable them to pass that on to lower rates into the economy and support credit growth. We remain of the view that the banks have got good buffers as a whole and can support credit in the economy. I think it's fair to say we're seeing that playing out a little bit more in the housing market than we are in the business lending market. That's partly because businesses obviously are cautious about taking on debt, but it's also probably fair to say that the banks are a little bit more cautious about the business prospects than they are about secured residential lending. So, still encourage the banks to be looking with at what they can do to help that business sector. That's absolutely crucial, and to take a bit of risk into that lending there. We obviously haven't made a decision on whether to execute that next set of policy instruments. It's what the committee did was made a clear instruction to the bank's operational teams to get ready. As people will know, we've told the banking system they have to be ready for negative rates by the start of December. The package needs quite a lot of design work. We want to hold conversations with treasuries and players about how it could be constructed, what the nature of a lending program might be, how we might approach the rates on settlement balances, and so forth. So it's a preparedness if we need to, but there is a reasonable prospect we might need to do more to support the economy. So I'm going to stop there, and there'll be lots of questions, I'm sure, but it's long enough intro for me, and let Toby just say some words on the regulatory agenda, and I'll pass over to him.
Okay, good. Well, thank you very much, Geoff. Yeah, so look, I'll just set out the landscape as we see it now. I mean, as you probably know, we put on pause virtually all of our regulatory initiatives until the 1st of October. We did that in close collaboration with other financial regulators. So we worked with the FMA very closely, MB, Treasury, and so on. And we've been having some quite good discussions with them and with parts of the industry about how we might sequence rolling out the initiatives again once we come online again. So they're all on pause until the 1st of October. And we've been thinking about, how we should think about prioritising what we roll out and when. And there's a number of things we've had to have in mind for that. So based on our individual mandates and the sort of overall vision that we have for the system, sorry, I've lost my track a bit here. Shall I start again? Stability of the financial system is obviously important for us. It's obviously important that we think about confidence and trust in the financial system. And also, we want to make sure that the banks and other financial providers can continue to support their customers. So with all those in mind, we're thinking about a sort of phased rollout of the regulatory initiatives. So sort of first off the blocks, one of the first things that we're looking to put out, which we've been working on for a while, is some guidance that we've been composing on cyber resilience. Now, Richard will talk about that in a minute, but it's something that we've been working with other relevant agencies on, so other government agencies, and we should be putting that out in early October. From the point of view of the insurance industry, we've also got the IPSA review and the Solvency Standards review. Now, we've been working closely with FSC, with the New Zealand Society of Actuaries, on how we should be thinking about the solvency standards. And we should be in a position to get something out to you in the middle of the fourth quarter on that. But as to the other things, we've already taken some further action in some of the sort of COVID-related initiatives that we had. So, for example, we and the FMA gave some extensions to reporting deadlines back in March. It was actually really encouraging that industry were able to submit their reports actually within the normal deadlines. So we've taken that concession off now. On the mortgage deferrals, as you're probably aware, we've been working with the NZBA, and we have extended that for another 6 months until March, but on the understanding that if banks consider that their customers won't be able to meet those obligations in the long term, then they should have some serious conversations and think about other solutions for customers. So the other area we've been devoting some time to, unfortunately, is thinking about how we might deal with entities that come under some sort of stress. So we've been looking at preparedness for that, our own preparedness, making sure that we have all the documentation ready if there's any critical issues that arise, making sure that we've had conversation with relevant parties like insolvency practitioners and so on. Now, just to be clear, we don't think this is imminent. We think the financial system is still in good shape, but our stress tests on the banking system, which we publicised in the FSR earlier this year, showed that there were some sort of non-trivial scenarios where the system could come under some sort of stress. So we're thinking about that and thinking about issues such as how much encumbrance on banks' balance sheets we should allow, because clearly, if a bank's balance sheet is highly encumbered, i.e. they've taken their assets and used them as security elsewhere, then there's less to go around for depositors if the balloon goes up. So we're thinking about that, and we expect to come out with some consultation on that in due course. The other thing that's still been going on in the background, and I just want to spend a few minutes on, is phase 2 of the review of the Reserve Bank Act. We just call it phase 2. It's a multi-year review of our legislation, as you're probably aware. Phase 1 was about changing the monetary policy framework, and that was completed last year. Phase 2, phase 2 is about all other parts of the Reserve Bank Act, but it's mainly focused on the financial stability and prudential side. The first part of it, the bill, is actually in the House now. So that's what we call the institutional bill, and that's changing the governance settings for the Reserve Bank, changing some of our objectives. So we're going to have a governing board now. Current arrangements are that the board is a monitoring board only. It's now going to move to a more conventional commercial board. There's going to be new objectives for us. So the objectives are not going to be the soundness and efficiency of the financial system, but it's going to be simply financial stability. So a single, simple objective for the prudential side. And a number of other changes, such as the Council of Financial Regulators is going to become legislated. And then there's also a consultation paper out at the moment for the second part of phase 2, which is a review of the deposit takers legislation. There's been some decisions that have been taken on that already, some pretty important decisions, such as that the government's going to introduce deposit insurance as part of that, which is something that New Zealand doesn't have, a bit of an outlier, up to a limit of $50,000 per account, per person per account. There's going to be a single prudential regulatory regime for banks and non-banks. And there's some questions that we need to address about where the boundary sits, and is there going to be a boundary between banks and non-banks. So all of these subsequent questions are in a consultation paper that was put out in March and was supposed to be completed in Q2 this year, but because of COVID, the deadline's been extended till 23rd of October. So there's some quite fundamental questions in there about, for example, how the deposit insurance should be structured, whether we should get further supervisory powers, for example, to go on site, how the penalties regime should work. At the moment, the penalties regime is quite a binary option. It's either a nuclear option of closing down the company, or fairly weak penalties. So we're looking at a more graded option of enforcement tools there. And one reason I talk about this is because anything that emerges and gets into law through phase 2 in the deposit taker side would probably carry across to the insurance regime once we review IPSA. So I'd encourage you all to take an interest in C3. There's another couple of months to go before consultation closes, because it could have some, pretty wide ramifications. So yeah, I'll stop there and pass over to Richard to talk about the supervisory side and cyber. Thanks.
Good morning, everyone. In terms of operational matters that are currently fairly close to the surface and the front of people's imagination, not long after 9 o'clock this morning, there'll be a letter coming out, or an email coming out from me to controlling officers of all licensed insurers, which is passing on a communication from the NCSC, the National Cyber Security Centre, which is part of GCSB, relating to the current wave of DDoS attacks that are affecting the financial sector. At the moment, it appears to be more on the banking or pure finance related side. But that is not to say that the insurance sector will be immune from this. We're working closely with other government agencies in this respect, and a note will come out which provides basically some context and some useful information for your IT people to chase down if in fact they haven't already got this. And I know that some will have, but we also know that across the industry not everybody has quite the same level of connectedness. So we are working, as I say, with other agencies to get the information out there, and that will continue as long as this current firestorm, if you want to call it that, is going on. The world's an active place, and people are looking for creative ways to get money. I guess in New Zealand we may be protected from COVID. We're not necessarily protected internationally from some of the electronic stuff that goes on. So that will come out a little later on. In respect of Toby's comments about the changes that may come through solvency-wise in the banking and non-bank deposit taker side, we've been flagging for a while that the possibility of a buffered solvency approach is not unlikely for EPSA as it comes through. We don't, as I say, we haven't yet locked down on this, but be well aware that it's fairly high in our thinking to have a more graded and more appropriately graded solvency regime, and a set of supervisory levers that would go with that. And I think we've talked about that frequently enough in the past not to need to go much further into it. On the question of interest rates, negative interest rates, greatest effect, of course, in the more purely financial and money sector. Having said that, across the insurance industry, we are interested to know and will be surveying fairly shortly by way of a very brief questionnaire, maybe 4, 5 or 6 questions, which won't take very long to complete, but we'll be interested to gather general views on what the possible advent of negative interest rates could mean in terms of insurer operation. So we'll be coming out in that regard. And the final one, the other piece which everybody will be thinking about is our position on the withholding of dividends and capital management for the time being. As we've made very clear to everybody, our next position, our next programmed review of this will be conveyed by way of an announcement sometime before or at around the time of it. I think we've indicated before the November MPS. Our position on that, and in that regard, at the moment remains unchanged. We haven't yet started taking a formal view on what the answer might be in November, but to forestall what I suspect will be a number of questions, our position remains unchanged from that which we published. I think a note went out to the world a couple of maybe 3 weeks ago. So that's where we are on that. Richard Kay, I'll pass back to you at this point, I think, and see how it goes.
Thank you, Richard D. Thank you all, Geoff, Toby, and Richard. A number of great questions come through. I'm going to just start at the start, and then, Vince, if you just whoever wants to answer it. But there's a question here from Mark. When is the RB planning on reviewing its statements restricting insurers' use of capital? The restrictions of dividends, etc., are also meaning insurers are not able to validly redeploy or manage capital in accordance with their long-term and long-standing capital management plans, even in situations where their capital positions have improved since the start of COVID. Question number 1.
Jeff, do you want to take that one?
Well, I think you just answered it, Richard, which is that the statement on dividends we will update in November, either just before or at the FSR, so no change until then. I mean, I think more broadly, we continue to stress test the sector, look at how it's coping with under potential scenarios. We have imposed capital conditions on a number of insurers to make sure that they've got sufficient buffers. There are still some with some stress under certain circumstances. Of course, the interest rates, keep declining. But also I acknowledge some of the stresses haven't yet played out in the way that they could. But it's too early to cry victory, and cautious approach is appropriate. So we don't want to see those capital positions diminished at this point. And we will update in November, so I'm not sure I can say anything more on that. Only thing to add would be that in terms of the capital review implementation for the banking system, we will also update sometime in our plans on that in October or November. We are considering that at this time, and will be part of the regulatory update that Toby was alluding to.
Thanks, Geoff. Geoff, this one's probably for you as well. This is a question from Ryan. What would be you mentioned further stimulus potential coming down the pipe. What would be the quantum and form of any further stimulus that the RB would consider?
Well, it's pretty hard to answer the quantum because, obviously it depends on our reading of how much stimulus we think is already playing out and effective and how much is needed. But I suppose it'd be fair to say, just to put some orders of magnitude on it, that it's very well. There's no real case anywhere in the world where negative interest rates have gone below -1. Generally speaking, they're around -0.5 to -0.75 if they're deployed. Some countries have deployed them, a lot haven't. Funding for lending program, part of the design is to work out what quantum would need to be to support the asset purchases and the other parts. So it's a package of measures if we deploy it to add some more stimulus. So I can't really be more precise than that, I'm afraid. It's sort of looking at I suppose the only thing I could additionally say is that we did put in the NPS that we thought under certain modelling assumptions that you might have what we call an unconstrained OCR. It's sort of like, how much stimulus do you really need on this scenario to get the economy back to where we'd want it to be, in full employment and inflation back at target. And we said that might need to be -2.5. Now you've got to judge how much stimulus you think asset purchases are providing, everything we're doing. The yield curve's a lot flatter. We've got government bond rates down at around under 0.6 at the moment, 10-year bond rate. So there's a lot of stimulus going through anyway. How much that is, maybe it's -1, or more. There are different estimates around, and there's fiscal policy and all of those things come to pass in this judgment. So and things move over time. So that's just a longer way of saying I don't really know what the answer to that question is specifically, and we'll work that through in due course.
Toby, one for you from Kevin. How concerned are you about deposit insurance signalling a lack of confidence in the bank's stability to their customers?
Yeah, that's always a risk that you have to have at the back of your mind. But you would certainly, it would certainly be a different situation if you're putting it on in the midst of a crisis compared to in normal times. And we have a basic rule that we try and put the roof on when the sun is shining, and the sun was shining last year and the year before when deposit insurance was first being mooted. Government took the decision to go with 50k before the COVID crisis hit. I don't think there's any sense that the 50k deposit insurance that's being proposed now would in any way be seen as a panicky response to bank fragility. Just to elaborate on that, 50k is relatively small by international standards, and as a rough rule of thumb, it covers about 80% of depositors, but only about 20% of deposits. So as a way of shoring up, the banking system, it would not be particularly effective in that there's still 80% of deposits that could run. It's more a consumer protection play, I think, making sure that if people's banks do fail, they've at least got 50k available, or 50k or whatever they had. So yeah, I mean, I think it's some years off when the legislation gets through the House and so on. So yeah.
This one might be for you. It's from Simon, commenting in a question. With respect to the extension of credit business, I certainly endorse your view that there does not appear to be a surplus of appetite for lending. The question is, do you anticipate that your package of lending could include risk sharing on behalf of the RB?
Richard, you're a little hard to hear on some of that, I'm afraid. So I got the last part of it about risk sharing. This is in relation to the funding for lending, or was it?
That's correct, yeah. Do you anticipate that the package of lending could include risk sharing on behalf of the Reserve Bank?
The short answer is that we are in the design phase. What we wanted to do was articulate that if we were going to do further, it would probably be of these forms of instruments, but we would need to engage further and do more design work to going back to Ryan's question before, onto quantum, but onto eligibility, onto conditions. I mean, there's a mixed picture on conditions. A lot of the time around the world have been conditions associated with these term lending programs having an expectation that the banking sector does increase credit to the business sector, passes it on at lower rates, etc. On the other hand, you can tie these things up in knots, and sometimes the indirect impacts of just lower funding costs is possibly seen as the biggest, merit of the scheme rather than the conditionality. So I just think there's quite a bit of design work still to be done. And I see there's a question, if I may, Richard, from Craig on will there be a cost-benefit analysis on the impact of negative rates and so forth. Let me emphasise that we evaluate all of our alternative monetary policy measures, if you like, against a set of principles that we've espoused. Effectiveness, will they have the impact we want to see on pass through to the economy and benefit unemployment or employment and inflation and economic support? What's their efficiency impact? Do they have distortionary, neutrality impact, non-neutrality impacts? What's their impact on financial stability? Some of these things can be difficult. They favour some institutions over others, depending upon access, ability to utilise them, and then operational considerations and also public sector balance sheet risk are in those 5 criteria. So 5 principles. So yes, we I wouldn't call it a quantified, tightly dollar-specific cost-benefit analysis sometimes people think of, but certainly an assessment and evaluation of the costs and the benefits of the policy has to be undertaken and would be before we determine whether to proceed. But you are weighing up the benefit of supporting an economy that has large negative effects on if it's not working well. It's very hard for businesses, for households, for unemployment, versus potentially some side effects and negative impacts on some parts of the economy, and you have to try and work out how those balance out.
Thanks, Geoff. Richard, this one's probably for you. Question from Nick. Could you give an update on the RB's work on IFRS 17 from a capital perspective?
Yes, thank you, Richard, and thank you, Nick. Our work in this is underway. Adrian Allett is our person driving it internally at this end. There is a clear link to the Reserve Bank solvency, insurers' solvency standards, and there is also a clear time-based imperative wrapped around the target dates for delivery of IFRS 17 for the industry. We are well engaged toward that. In terms of absolute dates right now, I can't give you an indication that's going to be at 3 o'clock on the 29th of October next year. Nick, I can't be quite as precise as that, but it is underway. The environmental realities wrapped around this we're well aware of. It has to work for everyone when it's all in place, which means that our work has to be done and there has to be preparation time. We fully understand that. That's about as far as I can take that at the moment.
Thanks, Richard. Geoff, this one might be for you, or perhaps for all of you, gents. It comes from Lloyd. Does the RB have a view of the timing and likely impact of a COVID vaccine in its monetary policy considerations and discussion?
It's an interesting question. We actually decided not to pin our scenario to a particular vaccine date. We figured that was really difficult and with mixed messages and could create a lot of uncertainty if that date keeps shifting and so forth. So as I said, actually our core assumption was really the border assumption, and if you like, underneath that is some perception of how widespread might be vaccination, at what point might risks be low enough from people travelling around the world that New Zealand's prepared to let more of them in. But so we went with that assumption that the borders would effectively be closed until the end of next year, so we all hope that we see a vaccine developed, be effective and be distributed widely. But its distribution is a huge challenge, both to the extent to which we New Zealanders in the queue, but also to the extent to which all the people who are coming to New Zealand have got it, received it, and it's proven effective. So we can vaccinate ourselves, but it's not much help if we're just getting huge inflows of high risk people and you haven't got 100% penetration of it here and everything else. So I think no. Look, short answer is no. It's not a specific date assumption. I just reiterate our border assumption was the way we chose to underpin the scenario.
Thanks, Geoff. Folks, we're going to wrap in a couple of minutes. Just one or two other questions. If the Financial Services Council has been out this year doing a lot of research, and particularly around financial resilience, we've now done it 3 times, and all the data is coming back as New Zealand seems to be in a pretty resilient place. This is 2,000 individuals responding to a survey. I guess the question is that your sense, and have you been surprised in your modelling at the resilience of the economy, of households, of businesses, or do you think we're getting kind of early run readings that perhaps might not be entirely on point?
I think the big picture story is we think this is a very, very severe shock and is going to have significant impacts on business failures and unemployment. And I think that what we have been a little surprised is that it just hasn't come through quite as quickly in the headline indicators of that as the real economic impact is truly there. We have, and so we still see over the next 6 months quite a significant deterioration in economic indicators and more of that cost to become visible, if you like, apparent. I think the wage subsidy has helped cushion it. It probably has actually avoided some of it, but it's also delayed some of it. And that subjective was a very good one to get money into households and to help and into businesses and into households to help them and to keep people employed for longer. And there's a real benefit of that. That fiscal policy is a direct way of helping the economy, more direct than just lower interest rates, which is sort of an indirect channel. But you don't get through something like this without unfortunately some severe economic and social cost. resilience, I suppose, has a number of forms. I mean, as I said, we think the banking sector has got enough buffers in it that it stays strong. So there's a resilience there in that sense. It can absorb some losses, absorb some shock, and not fall over. That's what you want. That's why we impose capital requirements and regulatory settings and liquidity settings and so forth. The last thing you want is a financial sector under enormous stress at the same time. So we feel confident that through our work that it's got some resilience. If this plays out very deeply, very negatively for a very long term, of course the financial sector will come under more stress. And our stress testing showed that could happen. It's not what we expect. So yeah, sort of don't read my remarks as we see that we're getting through this unscathed. We're not getting through it unscathed. We've got through it slightly less scathed so far than we perhaps expected at this point. But we still see a lot of pain and a lot of stress, and we still need a sector to stay strong.
Richard, if I could just come in quickly on that, two things to say. Picking up on that one, I guess the difference between the view from a public resilience survey and the Reserve Bank's position is that we have to take and we do take an entirely dispassionate view on it. There is no sentiment, there's no natural human nature-based optimism. We just look at absolutely the facts. So that's inevitably going to provide some slightly different perspective and a bit of a gap between the positions anyway. We just take an entirely dispassionate view. Sorry, just on I see one last question just come in from Nick Lewis on the DDoS attack. Have attacks been underway in New Zealand, or are we seeing activity overseas and taking a precautionary approach in anticipation of possible attack? Be aware that there are attacks going on across the more in the banking and pure monetary related space in New Zealand right at the moment. Minister Farfoy is actually in the media this morning saying he doesn't think this current wave of attacks is a state-sponsored event, but it is certainly there now, which is why we're coming out now. We will be coming out now with some advice for all entities to, in terms of a couple of things to look at and consider. Thanks, Richard.
Richard, and thank you everyone, both in camera and those out in the marketplace. Really appreciate your time. I might hand over to Rob Flanagan for some closing comments, but certainly on behalf of me and the audience, great insight again this morning, points us in a direction, ability to ask any question, and really appreciate your frankness and insight. Rob, over to you to close.
Yes, thank you, Richard, and thanks, Geoff, Toby, and Richard for coming along. I think these conversations are very, very helpful, and both ways, I guess. And we look forward to having further conversations and working with you, with the Reserve Bank through this period of different times, I guess. So thank you, and thanks for everyone who have dialed in this morning.
Thanks, Hope. Good to talk with you.
Thank you.